Welcome to Founder Tactics, a podcast about entrepreneurs and the communities that shape them. I am your host, Julia Lucidi, and today we have a special edition of the podcast. We will be tuning in to a live recording from the Fort Lauderdale Tech Meetup. At this edition of the Meetup, we hosted our first panel, inviting investors to come and talk about the investor ecosystem and the dynamics of investing in early-stage startups. The moderator was Jonathan Lowe, VP of Startup Finance at EisnerAmper, and we had three additional speakers: Andrew Davis, investment partner at MakerX, Sredni, managing director at Azul Partners, and Kathy Chiu, managing partner at Deepwork Capital. I hope you enjoy it. This episode is brought to you by EisnerAmper, one of the premier accounting firms in the U.S., helping tech companies from seed stage through IPO by helping them develop the financial frameworks that turn ideas into commercial successes. Visit EisnerAmper.com. It's also brought to you by eForce Marine. eForce Marine is at the forefront to marine electrification. They are manufacturing 100% electrical boats, committed to a greener future and redefining boating and innovation. Visit eForceMarine.com. And this episode is also brought to you by Vultr, the world's largest privately held independent cloud infrastructure provider and an elite partner of NVIDIA. Vultr is on a mission to make high-performance cloud computing easy to use, affordable, and locally accessible for businesses and developers around the world. Visit vultr.com, VULTR.com.
My name is Jonathan Lowe. I'm with EisnerAmper Outsourced Services Group, where we help grow startups. So I will be the moderator this evening. So thank you for having me. So just a show of hands, how many of y'all are founders? Okay. And then how many of y'all are investors? Thank you. And then how many of y'all are supporters of the startup community?
I'm wondering if you have deal.
Yeah. How many don't know what we're talking about today? Okay, we got a few. So just for y'all, tonight we have a fabulous panel of investors, venture capital investors, for all of us to learn more about the ecosystem and gain some industry insight. So I'm going to pass the mic and we'll just do introductions.
Andrew Davis. I'm a partner with MakerX, a venture studio out of Australia. I'm a bit of a recovering venture capitalist, which we'll talk about. But my background's in building tech companies as a founder, working with probably around 50 or so companies from early stage to late stage. Thank you, Julia. Working with Google and Comcast on new projects and initiatives, and investing in a bunch of companies around the world with tech stars, and also doing some film and TV finance.
Hi, I'm Kathy Chiu. I'm a founding partner at Deepwork Capital. We're an early-stage venture capital firm. We started out in 2015 when we realized, these underinvested markets like Florida has a lot of potential. And so we started fund to test it out, and we're now on Fund 3. Along the way, we also became the investment manager of something called Florida Opportunity Fund, which is the state, just throughout various venues had chunks of money that they set aside wanting to invest in the venture system. So we do that as well.
Hi, I'm Sredni, and I'm a founding partner at Azul Partners. We're also in our third fund, $100 million fund. And we're investors in the B2B and deep tech space. We got recognized as being one of the top 10 deep tech funds in the U.S. And before that, I was chairman and CEO of a public company for about 20 years. It's great to be here.
Thank you. So I'd like to start out with a couple questions to warm up. One, we already kind of went over your organizations, but could you share with the audience the additional value added that your fund brings to your portfolio companies, as well as any investments or exits in Q1 of this year?
We're a venture studio, so different than a venture capital firm that deploys capital externally. We build all of our companies in-house, except for when we do joint ventures with larger enterprises, larger scale-ups, or government entities. So we have a suite of services that we provide to the portfolio, lots of engineering and product, more specifically, just given the background of everyone on the team. And we're just getting kicked off. The company's been around for a couple of years now, hitting 8-figure revenue, and we're funneling all of those resources and talent and some intellectual property into a more proper studio offering.
So we are, I guess, your friendly, neighborhood VC fund. I know you're even more neighborhood, more friendly. But we do mostly Florida. And I would say that, our favorite, because you asked about investments lately and favorite exits. So our favorite exit, I guess, was our very first one, which was a fintech company that ended up paying back our entire fund in Fund 1. But my favorite, most recent investment is this. So after that company exited, the founder went on, and then they became a unicorn and all that kind of good stuff. But recently, the founder, which was pretty young team, founded a next one, and we were the first people that they called. So we got to go in again, and it was my favorite, not just because financially it was great. It was also because of that relationship that we're glad that in the journey that we shared together gave us enough of a relationship that we're the first call.
Awesome. So we're all former operators in our fund. Most of the folks in VC have never run a company, and it's pretty easy to tell somebody what to do when you've never done it before. There's all kinds of great ideas that work on paper, but it's not so easy to do when you're running a company. So we get super involved with companies supporting entrepreneurs, and we want to be the first call when the proverbial hits the fan. Because nothing is linear and there's always going to be problems. So we want to be that first call. We're only around for 6 years now, and our favorite exit is the first exit too, which we returned 40% of Fund 1, and we still have we have 42 companies that we invested through the course of 2 funds. So that's my favorite exit.
That's awesome. So with those exits, and thinking about the current climate, with the dollars raised and deals down, what is your perspective of the environment right now in terms of venture capital deals moving forward?
So I'll start. My perspective is that the environment has been pretty tough for founders. Valuations were down. Some of the valuations were like sky high and were not realistic. We're now at a more realistic place. And what happened was VCs ended up not investing in new companies, but just saving capital to support the companies they were invested in. So it's a pretty tough environment. I see it starting to change now, where VC funds are investing more and more in startups, but valuations are still not. They're at a level they were, by the way, in 2017. So that's what we're seeing valuations. So they're more what I would say at a reasonable level. And we have a chart I can send to folks if you email me. But right now it's a more VC-friendly environment, where if you go back 3-4 years ago, it's very much a founder-friendly environment where valuations and terms were much more focused on stuff founders like. We're sort of getting to a balance now.
So I'm an optimist, and so I want to say that even when market is really tight, there's always 2 sides to the coin. And one is, you hear the word, people say flight to quality. And that's very much what's happening, because when there was a lot of money waiting to be deployed, what you're not really seeing is, it's not that experienced early stage people are jumping in at crazy valuations. What's really driving up those valuations were the later stage guys who feel kind of FOMO and then dumping a whole lot of money. And when that went away, valuation kind of cratered. But in some way, it wasn't a bad thing. And then, I guess it's easier to say this as an investor, to say, hey, you don't want your valuation to be too high. And you're probably sitting there thinking, yeah, right, because you're investing and you're trying to get a low valuation. But this is why, hear me out. When you are a very young company, if you immediately got a very small amount of investment, that is done at a very high valuation, what happens is next time you go out to raise, and you will because you raised a very small amount, all of a sudden you have this high bar. You're going to either have to disappoint that prior investor, or your company really have to hit all those milestones to be worth the next round, which is higher. And so in a lot of ways, you don't want to set unrealistic expectation unless you've got this rich uncle who was going to fund you all the way through at whatever valuation you want. And if you have that, congratulations.
I don't have too much more to add there. Some of the companies that we invested in outside of MakerX and my prior portfolios, they were having a hard time raising back in January, February, March, and things are changing. And it's really a testament to them building quality product and getting out to market and finding good business opportunities. And that should be the case across the board. Good times, crunch times, overinflated valuations, low valuations. Focus on building a great business, irrespective of what the capital environment is like.
Thank you, Andrew. So speaking of raising and valuations, whenever a company comes to you to pitch, how do you decide when you're going to write a check? Are you looking at the company, the team? What are the characteristics that really stick out to you before you bring out the pen?
Me? Okay, I get to go first this time. I guess this is kind of a loaded question. I can answer something flippant and say, oh, it's all about the people or whatnot. But maybe I'll just tell you about our process. And this is not a crazy process. A lot of VC have something similar. The first phase of my trying to spend time with you is in determining why should I even be excited. And so that is the phase where I'm extremely imaginative. I'm trying to understand you. I'm trying to build your case. And then once we all get there and we say, okay, this is why it could be a 10x, could be a 20x, it could be this and that. Once we understand the potential, then we turn and start getting negative and go, but there's 101 way to die. What are they? And then we start going down, 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 down. And once we go through that phase too, then we come back up and say, okay, what does this all add up to? And fundamentally, what we really want to do, people think of VC as people who like to take risks. Wrong. We hate risks. We only take risks because that's the only way to get returns. What we're really trying to do is understand this whole picture of you to the point where we can bound the risk. All these are not the problem, is a problem, or, we're trying to get certainty around this. And in the middle was the insolvable uncertainty, and that is the bet and the risk we're willing to take. And we want it to be as bounded as possible.
There are so many considerations around the team and the market and the product and the competition. The list can go on. At the end of the day, it's for us getting conviction that you can build a great big business and take over markets. And there's, again, a checklist of things that we look at to try to get that sense of conviction. And it looks fairly different company to company, stage to stage. I'll say that parenthetically, between pre-seed and seed. But for me personally, as I'm chatting with founders, one of the most consistent things that has caused me to make a decision and cut the check is getting inspired by the founder, their vision, and my belief in their ability and their team's ability to execute in whatever vision they're painting.
Yeah, so to add to what both Kathy and Andrew said, deep expertise in the subject matter that you're involved with, the ability to raise funds. So many CEOs tell us they're not good at raising funds. That's not good because you're continuously going to have to raise funds. And conviction that you're going to be able to win. We don't like Me Too companies. Sometimes there's so many startups who just tweak an idea and just change one thing and think they're going to succeed. So we're looking for folks that really want to change something and disrupt the world. And at the end of the day, do we believe that third person and that team can do it? Co-founders is always great because, again, we don't like risk. And if there's only one founder and no depth in the team, that can be challenging. So for me, it's obviously the horse has to be important, but the jockey and the team behind the jockey is most important. So often we invest in a company that has one idea, and a year later, 6 months later, 18 months later, the idea is different, but ultimately it is that entrepreneur that's going to make it happen.
Thank you. Regarding the founding team, how do you balance a conviction or a founder who's very convicted through their idea and coachability? You know, like depending if they need to pivot or take in some ideas or maybe reevaluate the team.
I think those things are very related. Most great startups are not afraid to fail. And they fail fast. You got to try different things, fail fast, and pivot. So I think it's important when you're convicted, when you have conviction to an idea, you have conviction also to the fact that you don't have all the answers. And I think most great companies are married to a general concept and try to follow that, but they have to try different things along the way. And I think it's the culture they got to build.
There's a really interesting balance between having personal conviction in your business and being able to convey that with a lot of confidence and even certainty, and balancing that with intellectual honesty and humility to say, we've got assumptions and hypotheses and strong opinions about some of this stuff, but we don't have all the answers. Like, that's an immediate turn on as an investor. It's like, I understand that you're thinking very critically about your business, and it means you can criticize yourself and your business. And from a coachability standpoint, a lot of points.
So to me, the coachability issue is actually not intertwined with conviction, because I think a good founder has strong conviction, but they also have crystal clear vision of what the existing situation is. So they know what they know and they know what they don't know. And that's what makes them coachable. Because, by the way, along the ways of this, and ourselves included, Rob, here, sometimes we would give bad coaching, to be honest. And you need to be able to know the difference where you really know the space and where you really don't. So, for example, most likely when you're dealing with investors where they can be very helpful, transactions. If you're about to go sign up your very first big transaction, it's not a bad idea to run it through your investor or your board, because most likely they've seen this many, many times and you haven't. On the other hand, your industry expertise. My gosh, if you're going to your investors and saying, what do you think of this? And they're looking at it going, this is really scary because I bet on this horse or this jockey, and this jockey doesn't know how to ride. That will be scary. So I think it's about knowing when.
Speaking of transactions, since we got some founders in the audience, how do you consult them on how much to raise and what stage to raise from each round?
For me, a lot of the coaching goes into raising what you need to hit certain milestones, and particularly to get to the next round. One thing that is entirely underappreciated for early stage founders, especially first-time founders, is financial modeling. And most of it is going to be wrong. That's not what the exercise is about. It's understanding how your business works and understanding the levers that you need to pull and push to get to certain outcomes. And so that's it's not something that is needed when we invest. It's something that we actually work with founders a lot on, but that's always helpful if they come in having that sort of depth of understanding of their business. They've been thoughtful about the various assumptions and components of their business.
Well, in this environment, all I would say is raise, with enough margin for error, because things won't go perfect.
I'm with Kathy on this. No business is going out of business because they raise too much cash. And often founders are so hesitant to raise cash because they're diluting themselves. And you always need more cash than you think you do. And what happens is you have these founders that are razor thin on how much they're going to raise, and all they do is 24/7 is raise capital. They never get out of the capital raising mode, which is very dangerous because running a company is a full-time job and raising funds can be a full-time job. So my advice to our founders is to raise more than you think you need, and to be very, very efficient on the way you use that cash.
Speaking of uses of funds, during the pitch, they already have an idea of what they want to use the funds for. Do you ever add inputs on maybe adjusting some of the weights to different focus points, such as R&D or marketing, or even back office support?
One of the areas, especially over the past couple years with a lot of these AI companies, where we've had to push in certain instances as founders underestimating how much they need to train and build their models, which is just, it's a lot. And particularly first-time founders aren't always aware of how much goes into some of that technical build. Besides that, perhaps marketing, and actual go-to-market, cost of acquisition to acquire certain users, depending on where you're at in your stage and what your business is. Yeah, those are some of the areas.
I have a more practical answer, which is normally when you raise funds, you want to raise funds for at least 18 months. And most startups cannot predict what's going to happen in 3 to 4 months, no less 18 months. So when I look at projections, I've never seen a projection doesn't go up and to the right. And I've never seen a projection where the company keeps improving margins. And so to me, what's more important is what are the steps the company's taken? How do you make sure the cash is being used efficiently? And what are the tests you're making? And what are the levers and the milestones that you're picking in order to spend more cash? Because so many bad founders just spend the money and think that success will come, where I think a more reasonable approach is to have milestones, see what you learn, fail fast, and then just continue to spend as you learn.
So I think the question, I think, was, like what percentage or some sort of rule of thumb on how to use funds. And I think my only advice there will be to think about the order in which you spend money. Don't be spending money on marketing if your product isn't ready, because I've seen a lot of money being frittered away that way. Don't go hire a huge sales force where you've got nothing to sell. And if you start finding that your customers are churning because there's problems, you don't necessarily want to go out there and acquire a whole bunch of more of them. So now instead of 10 customers being pissed at you, now you got 100. So that's only thing that's along the side of how to be more efficient with the usage of your money.
It's a trade. I am today trade.
Well, but it's been on trade. Okay, that.
Yeah, thank you. That was our break, by the way. So with the first-time founders out there, you're probably told, like, hey, you need to raise capital and raise, but they may not understand the business model of venture capital. Could y'all describe briefly the actual business model of VCs and the difference between what's called internal rate of return of the fund and the portfolio company?
So most VCs have a model where they'll make 10 investments and they expect 3-4 of them to fail. They expect 3-4 of them to do okay, maybe get their money back, and to have 2 big winners. And the way the math works is you really need to make sure that your winners return the fund. We have a different philosophy, which is we don't spray and pray, which is what it's called. We're pretty selective at the companies we look at, and we're all in and try to make sure that those companies win. But at the end of the day, we are raising money from investors, so the money's not ours. We're fiduciaries to our limited partners, and they gave us money to get a certain amount of return, and that's what we're striving to do. And ideally, for a fund, you'd like to get at least a 30% return, right, for the risk that people are taking. In reality, if you're a good picker and you diversify, you should do okay for your LPs.
Yeah, so I would say that a sing-songy way to answer that is, a lot of these alternatives, VCs, PEs, or whatnot, they say, 3 to 5 times in 3 to 5 years. Actually, that usually is PE because, VCs are a lot longer, right? But if you back that out, any alternatives, if they're not returning, say, like a 3x, if they did a 3x, that's considered a good fund. If they're doing 2x, they may or may not raise another fund. If they did like a 1x, they probably are run out of town. So that's the pressure we're under, and that's it.
Yeah, there's a big expectation for VCs. The limited partners, as Ella was mentioning, these are high net worth individuals, family offices, pension funds, insurance funds, university endowments, and venture tends to be a very, very, very small sliver of their allocation and their portfolio construction and all the things that they invest into. And they're expecting monster returns from VC. And the model itself, if you have a $50 million, $100 million fund, and you have a company that goes and exits for $1 billion, let's assume that there's 5% that the VC owns at the point of exit. That's only $50 million. You've got $1 billion exit. You think it's a great outcome, but for the VC, you've only returned half the fund. And so it's a really, really tricky model for us as investors, but for the founder, incentives aren't always aligned because you could have a wonderful exit, get $20 million, $30 million for yourself to build generational wealth for your family, but for the investor, it's nowhere near cutting it. And so it's really important to understand the type of investors that you're going after, understanding how big their funds are, their ownership percentages, and digging into their specific models. They're not all the same. Different fund sizes, different portfolio construction, different ownership targets, that the list goes on. And doing your own diligence as founders, as you're having these meetings with investors, is so important.
Thank you, Andrew. So kind of expanding upon the VC side of the model, how should the company or the founder think about when looking for a... That's everything you need to know. Where was I? So how should a founder or a company think about when trying to partner up with the VCs? Maybe like matchmaking rather than kind of like finding a rosters of VCs and just knocking on doors for anybody who will write a check.
I think the partner you pick, it's pretty important. I tell people when you marry somebody, you can get divorced, and if you have no kids, you're done. With a VC, it's not quite so simple. It's even more complicated. So you have to make sure that you have the right partner that sees eye to eye, somebody you can rely on, that you feel comfortable with, and that you really trust, and that they trust you. So it's very important to come up with the right relationship.
Yeah, I would say that there's two parts, right? One is, you want to be scanning the C's of VCs in an effective way so you can actually get to the altar. But yes, once you're evaluating them, then you can start picking. But, I think on the very first cut, you should cut out all the VCs who, frankly, are just not investing in your kind of industry or your kind of deal or, So that's like a very simple one. But after that, it really is just about the people. How do they work? How hands-on are they? And how much can you stand having people there getting involved? Because everybody's preference is different.
Yeah, I love that getting to the altar piece. You should be treating fundraising like a sales process. So that's really what it is. And a big part of sales is understanding the people on the other side that are most relevant for you. And that across stage, the experience of the investors, the stage that they invest in, the industry that they invest in. I can't tell you, and I'm sure similar experiences with my colleagues up here, getting pitched and getting reached out to from, if I'm an AI fund, I'm getting stuff in a hardware or clean tech. So just being so careful to make sure you're finding investors that actually align with what you're building, because you will stand out immediately.
Check references. Can we get another mic? got towards last time. I'm down for the down.
Check references. Go to other founders and make sure that that they like the VC that they're. Can you hear me? They work. Check references. So many founders don't check references. If ask the VC to talk to some of their portfolio companies, or just pick any portfolio company and call the founder and get a reference from that VC.
Thank you. Check references. Remember that. So for the founders out there, you finally found the perfect partner in terms of the VCs, and you got a term sheet. So for the panelists here, what are like the key things that everyone that should really check or really sticks out, and how has it changed over the last 5 years?
I mean, there's so many terms in a term sheet. You should have a good lawyer, right? So make sure you have a lawyer that understands VC, that's done this before, and that can be a good advisor to you. Somebody that really knows their stuff. A lot of people pick lawyers that have never done a VC deal. That's not a good idea. To me, there's so many. Everybody focuses on the price, the valuation of the company, but there's issues about control. There's issues about vetoes. There's preferences that you get if the company's liquidated. There's interest that you're going to pay if it's a convertible note. So there's just a lot of different terms. Just don't focus on one. Make sure you get good advice from somebody you trust.
So when people ask me, like, what terms are coming in or going out as if it's some fashion trend, I would just say, take it this way. Any terms or some instruments, they're just that. They're instruments. They're toolboxes in the investor's arsenal to do specific things. And since there's like drinks and people dancing, I don't want to be, like going through what's a convertible note, what's a safe note, what's a whatever, because, this is not the right forum. But you should know what each of those instruments do, because they all do specific things. They're protecting against specific scenarios. And to Sal's point on why you should have a lawyer, because you can have a brilliant lawyer, but if they're not practitioners in the VC space, what they might do is they'll over-lawyer it. And then eventually your VCs would not want to play with you because you're too painful. And they are arguing about corner cases that have like a minuscule amount of chance of happening. So that's what.
Really quick show of hands again of all the founders in the room. How many founders are raising? Keep your hand up. Go by tonight, if you haven't read it already, Venture Deals by Brad Feld, one of the founders of Techstars, gets into a lot of depth around deal terms, just one of the things, but running a process, what it looks like to raise money from a technical standpoint. It'll save you a lot of trouble and help you understand this space. Because investors, we do this day in, day out, and there's information asymmetry that you can help to sort of bridge by digging in some of those things. So, vote on the book. Venture Deals.
Thank you, Andrew. So shifting gears a little bit with the new topic that everybody's really hyped about, which is AI. Andrew, you mentioned this earlier. So it was quoted, a futurist said, there's only two options for businesses regarding AI, either adapt or go out of business. So what do you guys see in terms of opportunities, and how do y'all feel about the valuations you're seeing?
AI is really interesting right now. It feels like every 9 months, more or less, OpenAI is coming out with things that are building an ever-growing graveyard of startups. And it points to two really important things. If you are using AI, building AI, from a technical standpoint, if you are building something very, very technical, make sure you have an edge that can't be easily disrupted by a company like OpenAI or Google or any of those guys with massive venture dollars. But in another interesting one, which is maybe more important, is data. A lot of these companies are going out and scraping the public web, regardless of what content type, to train these models. And there's a massive amount of regulation that is coming, and lawsuits that are happening globally. And so there's so much risk if you try to go a similar approach. That said, if you have access to proprietary data, whether that's by your customers or a way to acquire some of that by other means, it's a really, really strong differentiated advantage, and things that are really interesting for me to look at, because that means that your models are safe and the quality of them are immediately going to be higher than what you're going to find with some of the other competitors out there. So those are a couple of things that I'm looking at.
So the way I see AI is that in the middle was the big players that are battling it out, and none of us probably really have a whole lot of influence over that. You can throw a few dollars in the public markets and bet on the stock market. That's how you play that. But the upstream from it and the downstream from it is where some people here may actually be playing, and us as well. Upstream on it is the enabling technology, things that enable the AI to be more efficient, the training to go faster, the cost to reduce. So there's a bunch of those. If you find yourself to be in one of those, likely you're a very technical person, or at least you have a very technical team. If you're in that space, just know that the competition is really fierce, and there's a little bit of a winner-take-all kind of situation. So you really need to walk in, understand your context, and then just run like heck. And your VCs expect that, and when they bet on you, they're betting on that too. On the other hand are the applications of AI, right? ChatGPT is getting really good. We can all do something cute with it. Heck, I can even write my term paper with it. So great. If you're in that space, you need to be very careful, because AI is nothing but a tool that keeps you competitive, because everybody can use it to become more efficient and do the same thing better. You still need to make sure your core business is sound, because that is ultimately what you still are. You just need to know that everybody's now using AI. You cannot be a dinosaur. But your core business is still evaluated by the investors the same way they have always done. So if you're an application of AI.
Yeah, and just to add what Kathy said, we see so many startups that are in the AI space, but all they're doing is training robots with OpenAI or Google, and it's not really anything unique or different. It is just taking advantage of technology. And I'm old enough to remember when every company added a .com after the name, because the internet was going to be the big thing, and now everybody's talking about AI, but really very few companies are really innovating with it. And what you need to do that is you need a proprietary set of data, right? Because if you don't have any proprietary set of data, you really cannot train the models any different than anybody else could.
So with AI being the future or potentially a huge disruptor, where should the founders and companies, how would they stick out in terms of a competitive advantage for the remainder of this year and next year for VC activities to attract folks like yourselves?
Again, they have to be doing something unique with a unique set of data or something that makes them stand out from the field, because anybody can train a robot to do or a chatbot to do just about anything pretty easily. The question is, do you have proprietary data that's going to allow you to succeed where others are going to fail?
Yeah, it's the case in many instances that founders might be building something, and there's another company that's at Series A or Series B building the exact same thing, and you aren't aware of it. And even at an earlier stage, with something that might be a bit more novel, you should assume that other people are building this somewhere around the world. It's a very, very big world, and it's not impossible, but rare to find incredibly, truly novel ideas. And so on that side, execution wins every day. And there may be companies that are competing and doing some of the exact same things, but for one reason or another, proprietary data sets, maybe it's just go to market execution and pure hustle, you can come out on top. So the bottom line is Just focus on your business, execute, make sure you're doing your research at a high level to make sure there aren't any glaring folks doing exactly what you're doing. But besides that, don't focus too much on the competition. Go out, try to build and win in the market.
I agree with both of this. So basically, think of AI as a phenomena. It's an environmental change that you have to make sure you take into account for. It's no longer that's my differentiator.
Bringing it back to a local area, what's your opinion about how a community for startups adds value and success for your portfolio companies, and what characteristics help them succeed or increase the probability of success?
I ran a few cohorts at Techstars, and the cohort model is just so core to the success of our businesses. We'll start with one of my companies yesterday and out in London, and they brought on one of the other company's CEOs as a technical advisor. He's got amazing AI capabilities. So having community helps you fill gaps that you naturally have. Everyone's got them. And whether people that are further ahead than you, folks at the same stage with you, making sure you're surrounding yourself with community is so important, because building companies is hard. It's really, really hard. It's a full body workout. There's no area of your life that it doesn't touch. And so the extent that you have people that are doing the same thing, and again, that are a little bit further ahead, it adds just tremendous value.
So I think my answer to that, what characteristics do communities have that are successful for breeding successful startups comes from, most of it is just Florida, because I travel around Florida looking at all different ecosystems. I will say this is a characteristics is that a lot of this kind of interconnectivity that's somewhat general purpose. Because I think as a founder, if you're sitting in your own room and go, I came up with this great idea, now I'm going to find the programmer, and now you probably are not going to make it. It's just you're too far behind everybody else. Usually a successful founder started out with a problem that for some reason in their natural activity, they're just deeply ingrained and observed. So that's usually a deep insight to start a company. I would also say, though, however, like this kind of activity, how you get the most out of it is don't underestimate the power of weak ties. A lot of times you're thinking, why am I telling this story to all these people who have nothing to do with what I'm specifically doing? But people know people, and when you have an ecosystem that is very collaborative and eager to help one another, without necessarily thinking about a specific tit or tat, that's when these power of weak ties becomes a tide and becomes very powerful.
So being the leader of a startup is pretty lonely, pretty grueling, and pretty tough job. And it's nice to have somebody that you can commiserate with. That's number one. Number two, most startups go through sort of the same evolution. If you think of it as a funnel, first you're trying to figure out how to get interest in the company. Then you're trying to figure out how to convert it. Then you're trying to figure out, how to make them stick. Then you're trying to figure out how to land and expand. And my experience is that whatever problem you have, somebody in this area right here has likely gone through it and can give you some advice, and nothing like getting advice from somebody that's had your same problem and is on the other side of that problem. And a startup is sort of a collection of problems. You go from one problem to the next. It's never easy. So if you find somebody that, or a group of people that you can commiserate and can help you, I've always felt that entrepreneurs and founders are the best people to help other founders. And if you're lucky enough to find a group that can be supportive and help you get through your journey, I think you're pretty lucky.
Now let's bring it even further back and more personal. So what type of public tech company you admire and why?
I'll start. I love Netflix. And I love Netflix because it takes some big balls, in my opinion, to destroy your business every 3 to 5 years. And that's what that guy has done. He started renting videos, and then he went to he destroyed that business by mailing the CDs, and then he destroyed that business by doing the streaming. And I'm always very impressed that there is no sacred cows.
Yeah, I'm not well, like, got it.
So I love watching Netflix. I'm not currently invested in Netflix, but I would say, without naming names, because I'm afraid that just in case my gambling habit cause you to gamble on the same thing and it all crash, I don't want to take you all down. But I did go through and look at what are the enabling technology of AI, because I know this big wave is coming, and sometimes when there's a big sucking sound, that entire cohort is likely to do well. So that's what I'm looking at.
That's a hard one. Always been a big fan of Amazon. They've been so good at reinventing themselves over time, and with a company that size, there's still a very entrepreneurial culture and ability to execute and dig into new areas without fear. And I think that's really challenging for big companies. And the fact they've been able to do that pretty consistently is impressive. So one of my favorites.
Here's an even more personal question: was there ever a deal that you wish you could take back? And why did you pass on it? And for those founders out there, what advice would you give them when they get passed on, when they pitch?
So this is a company we invested in that we wish we didn't? Ooh. Well, wish we did. Okay.
Dang.
Yeah, there was a crypto company. I ran a crypto program up in Boston with Techstars, and it was right before the crash. And there was a moment where we had to make some very key decisions about the cohort and the portfolio. And we indexed a little bit on companies that could survive in a Web2 world and weren't straight crypto plays. And one of the companies that were in there was sort of a tokenomics modeling company that would help companies sort of work through the complexity and various variables to stand up a proper token offering. And we passed on them because we saw very clear that the market was tanking, and in the next 18 months, it was just going to be a killer for the market, and they probably wouldn't survive. They did survive. They raised great rounds. The market's kicking back. So that's one that got away that I wish we kept.
So for us, the regret, on top of the regret list, is a cybersecurity company. And for any of you who know cybersecurity, a lot of those companies don't start out as a software company. They're really kind of a professional services company with a little bit of software in it. And the day we saw this founder, he also probably worked like 48 hours prior to coming in. So it was looking a little loopy. And we're thinking, okay, this is a company that's really a body shop, and this founder is looking a little loopy. So we passed on that. Well, he went on to do tremendously successful because, he's not always like that. And recently, he took out an advertisement, and right in front of our office, every day we look out our window, there's a billboard with his advertisement on it. So that was absolutely the biggest regret that we've ever experienced. And I think our learning, and for any of you, is that sometimes if you had that conversation that just didn't go quite well, if you understand why, maybe we could have had a second conversation, but that never happened.
I'm a big believer in Stoic philosophy, amor fati, which means that everything happens for a reason, and you embrace whatever happens for that reason. We look at stuff we passed. We haven't passed on any big winners, but even if you pass, there's probably a good reason, and there's deals that we regret that we didn't get, and 6 months later we found out why we didn't get them, and it was for a good reason. So no regrets, and I think it's important as a founder to have that philosophy. Just keep pushing through, and stuff happens for a reason. Just embrace whatever comes your way, and that too will pass.
Carpe diem, right? Kind of. We have a few more minutes before we open up for some Q&A. For our panelists, what's one final piece of advice you would like to give our audience?
My advice is to make sure you pick your partners right, and picking the right partner is more important than picking the right valuation. That's easy for me to say, but I've had founders that come back to me and told me they were right 6 months later, where they ended up picking the wrong partner. And Kathy mentioned it before. So many companies pick a high valuation and they die as a result because they can't. The next round they have a down round. They're doing well, but they can't catch up to their valuation. And they're perfectly great companies that died because that founder did not want to give up X amount of percentage in the company. So just be careful that you do what makes sense.
I would just say that this is a really scary ride. So kudos to every single one of you for doing this. You're gonna have to be almost like living in fantasy land from time to time, because that's the only thing that could get you going. But just checking with reality also periodically, because you have to live in reality, and then maybe some fantasy can propel you to have the courage to go forward when the going gets tough.
It's incredibly hard work, and I can't underscore that and overemphasize that enough. Make sure you're taking care of yourself. This is a long game that you're choosing to go down, and it's just a ton of hard work, 40, 50, 60, however many hour weeks. But make sure you're eating well. Make sure you're spending time with your loved ones. Make sure you're taking care of your mental health. Those things, one, it's not worth it. The success of a business is not worth your mind and your health. The second part is your company is not going to die if you step outside and take a walk. So take a walk sometimes, get some food, spend some time with your family.
Or get a stand-up desk and a treadmill, right? All right. So we're going to go ahead and open up the floor for 2 questions. Okay. So just go ahead, raise your hand. I think the young lady right there.
Yeah. If you can state your name, what you do, and your question.
Hi, my name is Renata, and I'm the founder of Lumpo, which is a marketplace to connect fashion suppliers with brands. So our goal is to connect the entire supply chain into one marketplace. So you guys spoke a lot about industry knowledge, and that is very important for the founder to understand the industry that they're, diving into more than perhaps anything else. What would be the one piece of advice to a founder that is turning to a tech founder, but that has worked for the last, 10, 15 years in a more traditional industry? So with a traditional business model, and now is, turning into tech that works entirely different. Thank you.
So I think founders of the profile you mentioned, people who are in a specific industry, but maybe are working to disrupt the industry with technology because you observe the inefficiency, that's actually a great profile. Obviously, you have to have tech people that you can trust, maybe make them your co-founders so that they truly are fully aligned with you. But if you want to go down the path of saying, I don't need tech people, I'm just going to go outsource all that, then you need to be very careful who you pick as your partner, as your vendor.
I think that you don't have to have all the answers, but build a group of advisors that can help guide you, right? So if there's an area where you're not feeling 100% comfortable or you're not really sure, I would find people that you respect, that understand that piece that you're missing, and get them on the board as advisors.
Do you have any technical support today by way of advisors or someone that can, how hands-on are they? High, low, pretty hands-on? Actually coding, building? Yes? Okay. So you've got somebody here today you're in a better position than a lot of folks who come with deep insight into the industry but don't have anyone to build the tech. Kudos on that. I would say if you need additional tech support, leverage your advisor, there's people in your circle to go out to oversee some outsourced work in the event that you've got the cash to do that. And as always, as a founder, you've got a lot of hats to wear. One of them is recruiting. So making sure you're spending time trying to network and build relationships with technical talent to join you along this ride.
We have time for one more question. Or,
Hey, Johnny on the VC side. We're seeing a lot of uptick in down rounds in our deal flow. What do you see in the marketplace on your end? And how are you investing in these if that's an opportunity for you or not?
could you repeat that a little bit louder?
Sure. In our deal flow, we're seeing a lot of down rounds popping up. How are you guys looking at the marketplace? Is this an opportunity or are these places that you're looking to play at the moment?
Investing?
Not the best.
So if you're investing in a company, down rounds are not a great thing, but they're a function of the market. And you got to find a VC that can support your down rounds and up rounds. And there's a lot of pay-to-play rounds going on now. I see it as an opportunity. We're firm believers that this vintage, the 2024 vintage, is probably going to be a reverse vintage. So we're actively looking and very busy trying to figure out how to deploy capital.
I think it's like buying anything in bargain basement, right? The question is, right, is it a hole at the back or what? So as an investor, if I'm going into a down round situation, I usually look to see whether or not the insiders are also playing. Now, that's not always fair because sometimes they are in a down round situation because the insiders can play. Usually, though, what the insiders, even the ones that want to play, look for an outsider to put down a term sheet because amongst us friends, it's embarrassing to be saying, I want the term that's really stringent when maybe you don't want that. And so we end up saying, let's just let the outsider tell us what they think. Market has spoken, we can play or not play.
I just want to make sure I understood your question. Were you asking from the investor standpoint? You mentioned deal flow. Got it. Yeah, I mean, when you're looking at down rounds, like to Sal's point, like it's a function of the market, and I go both of what they were saying. If I'm looking at a deal and they're raising it at a lower valuation, or need to raise at a lower valuation, is it because the current investors don't have conviction and the company is just going south, or because they're constrained in their own economics and can't back this particular founder? There are a lot of interesting dynamics there, especially around signaling.
So let's take a moment and thank our panelists for taking the time and sharing their insights.
I hope you enjoyed that amazing conversation as much as I did. And I want to give a special thank you to our sponsors, EisnerAmper, Vulture, and eForce Marine, who made this evening possible and also supported the podcast. If you guys enjoyed it, go ahead and share this podcast with a friend, with someone who might enjoy this content. Truly, word of mouth is the best way that you can help our channel grow. And also, don't forget to subscribe, rate, and like the channel on whichever platform you're listening to it. That would be a huge help for us, and we just love being able to see our channel grow and reach more people. Thank you so much, and tune in to the next one.